You're not building the system for the 363 days when everything is smooth. You're building the system for the 2 days when everything goes crazy.
The Genius Act and everything with Trump has been active for a year now. How big has it been?
Something like that from an SEC chairman a year ago was unimaginable.
It's a complete 180.
Yeah, it's complete 180.
What can stop institutions from moving on chain? Like we just had the big exploit taking place at Balancer.
They don't know about that.
They're just completely unaware?
I think so, yeah.
Meet Sergey Nazarov, co-founder of Chainlink, the leading infrastructure layer connecting blockchains with real-world data, institutions and global markets. As one of the earliest builders in the space, Sergey has witnessed multiple cycles while continuously expanding Chainlink's role across DeFi, TradFi and real-world asset tokenization. In this second episode with Sergey, we dive into the rise of institutional adoption, the impact of new legislation, the evolution of CRE, and what needs to happen for smart contracts to reach global scale.
If we look ahead from that point into 2030, where are we if we go into the 0 to 1 global adoption?
You know, they say I'll go from no Bitcoin to 1% or I'll go from 1% to 5%. And that's already $1 million of Bitcoin.
So a personal question, how do you keep your mental state relaxed and alive during those periods of building a protocol like it is?
I keep it alive. I wouldn't say it's relaxed. So my goal in life is kind of not to be relaxed or really even to be happy. My goal in life is...
Before we continue, I would like to ask you for a favor. New Era Finance is designed and started to educate you about the future of finance. And I think that blockchain and Web3 is going to rebuild everything that we know about finance. And that's through those guests and the in-depth conversations that we have. However, more than 80% of you are watching this without being subscribed. And if we get more subscribers and more views, and we can start building this community, we can get better guests, we can improve the content, and we can start building. And in that way, we can start educating you even more. So I would like to ask you for a simple favor to check whether you are subscribed. And if you're not, please do, so we can start and continue to build this channel towards a bigger channel to help you all. Thank you very much and enjoy the episode.
Welcome back again to the show, Sergey. SmartCon has happened. How was it for you?
I think I've heard from many people that it's the best SmartCon we've ever had. And I think really the convergence of DeFi and TradFi that we're trying to create in the Chainlink community and that we were trying to exemplify in the SmartCon kind of talks and, you know, what the real point of the event was is to bring the DeFi and the TradFi folks together. I think I've heard from many people that, you know, that was achieved. So I was asking the DeFi folks if they were able to have interesting conversations with some of the TradFi folks, and also some of the TradFi folks. I was asking them, did you have, you know, interesting conversations with the crypto people? I don't say DeFi, I say crypto people because they don't. Some of them don't know exactly what DeFi is. And in both cases, you know, people were very positive on their ability to interact with each other and learn from each other. And I don't think there's many events like that. I think there's events that are very institutional and banking focused, and then there are events that are very crypto focused. I think it's good that we have an event that, you know, tries to do the same thing that Chainlink as a community and as a technology tries to do, which is, you know, bring these two groups together.
You've done SmartCon in 2022 in New York as well, and then to Barcelona, Hong Kong, and now back. In what way is the first version different to this one? Is it in terms of amount of people showing up, or is it institutions showing up?
I think it's institutions. So I think if you look at the agenda from the first SmartCon in New York, you'll see a few talks from institutions. Some of our earlier users like Swift and a few others. You'll see some talks from people that we were already engaging with, like the DTCC and others, who then went on to be users. But it's nowhere close to the amount of talks from institutions. I would say the majority of the talks at this SmartCon had, you know, an institutional side to them or were relevant for institutions. And that's because I think the world has really changed in a big way now for our industry, and that change is accelerating towards institutional adoption. And that's the big difference. The good news is that at the first SmartCon, we had a lot of great community members that were really excited that we were having our first in-person conference. We had another SmartCon remotely during COVID. That was like really the first one. But then we had, the first in-person one in New York. And that conference, I think the first one in New York was really great to get the community together more than anything else, which I know people appreciate and I thought was great. But, now we're in a different world.
If we look at the entire Web3 ecosystem, this has been my first conference in the States, in New York, packed, very positively surprised by the quality of people coming to the event, which, as you said, is completely different than when you go to a crypto-only conference, which is kind of degens all around. That's kind of the scope that you get. But as you can see that there's so much going on from an institutional perspective in the space, it feels like that there is such a big disconnect with the sentiment on social media or in general. How do you think that is happening, or why is there such a big difference between what's actually happening and what's being talked about?
So institutional adoption of blockchain and Oracle networks and smart contract technology is actually complicated, pretty complicated, because their use cases are complicated. And also they have their own terminology. So the terminology of capital markets of terms like delivery versus payment, or transfer agents, or fund admins. These are terms that are, specific to actually very specific subsets of the capital markets. And if you were in a different part of the capital markets, the traditional finance industry, you might not know what that means. Because it's a pretty expansive place where everything has become pretty specialized. So people who work on derivatives in the capital markets don't know what people that work on equities do, and people who work on funds don't know necessarily what the private equity people do. It's so specialized because each subset of that part of the world is big enough to be specialized and be very successful. So then what you do is you come in and you say, well, hey, we can change the way funds work, and we can change the way trade finance and global trade works, and we can change the way equities work, and we can change the way derivatives work. And so what you're really dealing with is you're dealing with really 4 or 5 different industries, and then they all have their own jargon. And then if you go over to the people that are outside that industry and you try to talk to them about, what is an ISTA agreement for derivatives settlement, right? Right there, you'll lose them, right? So the thing that I've noticed is that people are comfortable with the things that they're good at and the things they understand. And the institutional world is not something people in the crypto industry and the DeFi industry have ever really interacted with, except if they come from that world. So the people in the DeFi industry that I do sense, and I've always sensed, a lot of appreciation from, about like, wow, what you're doing is exactly the thing I think should happen, are the people that used to work in the financial markets, in the traditional financial markets, and that was their career before they went into DeFi. They immediately get what we're doing, immediately. And this could be as far back as 2017, 18, because they understand that world, right? They understand that you're going to need data, you're going to need bridging, you're going to need compliance and identity. Now, what I think is going to happen more and more is that as people's success in the DeFi world is driven more and more by the traditional financial client putting money in, or the traditional financial institution interacting with their decentralized finance protocol, there'll be a big incentive to learn about this stuff, and they'll get good at it. And then everybody will, be talking about all this stuff as experts, and they'll be using the jargon of the TradFi world, and then they'll invent the parallel word. They'll invent the crypto word for transfer agents and a crypto word for fund administration, and it'll sound way better. It'll be super exciting. And that's fine, because it'll get more people interested and excited, and it'll kind of get more people to understand. But some of the use cases we even presented here, and we launched with UBS for their tokenized fund, giving them transfer agency contracts and giving them net asset valuation price oracles. So 2 very specific concepts, right there. Then we announced our work with the Central Bank of Brazil, the Central Bank of Hong Kong, and Inter, the largest bank in Brazil. That was for 2 CBDCs to go over CCIP, the Drex Real, which is the Brazilian CBDC, and the Hong Kong dollar, which is the Hong Kong CBDC. That was over CCIP. And then CRE was used to synchronize with something called bills of lading. In this case, electronic bills of lading, which are documents related to what's being shipped, because this is a trade related transaction, global trade flows. And there you go, right? Bills of lading, right? What is a bill of lading?
I'm sure nobody understands.
I mean, there are people that understand, the people that work in trade finance, and that their whole career has been around global trade flows. And when we explain to them that we can take the bill of lading and we can synchronize it to a chain, and that bill of lading can get verified, and what it says is going to get properly executed and properly tracked via the chain, because an oracle, the CRE, the Chainlink Runtime Environment, verified and did everything that the bill of lading needs done or verified or processed or whatever it needs. To them that's impressive. So the problem is that these use cases are getting specialized.
Yeah,
that's not fundamentally a bad thing. That's a good thing. That means that blockchains and oracles are finding more and more places where they provide value. It's just complicated to understand. And actually, for DeFi, it's also similar. I find that a lot of people in the crypto industry don't understand DeFi. So they know what a Bitcoin is, and they know, how to get a Bitcoin, and they're going to hold a Bitcoin, or they're going to get ETH and they're going to hold Ether, but they don't know how to properly, loop across, multiple, versions of a token or pools or something. They're not like DeFi power users. They don't really understand how a lot of DeFi works, because DeFi itself is also very specialized. There's very specific concepts. So I think that, that for me is actually one of the exciting and interesting things, is that I and the other people that work on Chainlink, they get to interact with so many different use cases across chains. And they get to build technology that powers, global trade flows, derivatives settlement, equities tokenization, commodity, tokenization, fund tokenization, like all this stuff, right? So for me, it's exciting. For some people, because I want to learn. That's exciting for me. For some people, I think it becomes a little bit overwhelming, and they go, I don't feel comfortable. I don't feel in my comfort zone. I don't know what a bill of lading is. Probably some bullshit. It's probably not a real thing. And I wouldn't confuse the instinct that you're not comfortable with something with whether or not there's something valuable there. Does that make sense?
Yeah.
And I do think there's a lot of valuable stuff that blockchains and oracles do in places that don't have anything to do with decentralized finance. And as those things go on chain, they're going to benefit decentralized finance because there'll be more capital. But you don't need everything that oracles and blockchains do to have to be related to cryptocurrency, or that they have to be related to a decentralized, lending pool or some looping process that you have to juice, the yield on something. That's cool too. Like, that's a good thing. But I'm kind of saying there's a lot of things.
Well, you mentioned, I think there were many announcements being made on SmartCon, and one of them is UBS, but all those other institutions actually using CRE, and we could touch upon CRE in a little bit. Are we getting into a stage of, if we have from 0 to 1, we are somewhere in the middle, and from a game theoretical perspective, in a few years from now, you're actually behind by not using any on-chain protocol? Is that how institutions are looking at it at this point as well? Like, we have to do anything to be, as we can see how good this technology is and how more efficient it can be, we have to use the actual instrument that Chainlink is providing or any of the other ecosystems are doing?
So there's different categories of traditional finance that are in different stages of adopting this technology. Oracle networks, CRE, blockchains, and so on. There are really two driving forces. One force is the market dynamics that generate demand for whatever is tokenized. So what is the demand for a tokenized equity? What is the demand for a tokenized fund? What is the market demand for this thing? If I tokenize something, is there a market? Am I going to be able to sell it? Is there a reason for me to engage in this process of generating on-chain versions of assets, right? The second thing is the efficiency benefits. So the efficiency benefits are things like 24/7, 365 markets, 24/7, 365 collateral management. In traditional markets, the weekend is the weekend. There's no markets.
Yeah.
And collateral management isn't even as good as that. Collateral management happens on a schedule of 21/5. So 21 hours, 5 days a week, which is a bit insane, frankly. At the end of the day, the efficiency, I think, will be a huge attracting force. But I don't think you'll be able to prove the efficiency until there's enough assets on chain that those assets begin interacting with each other and with stable coins to generate markets. So the key thing that I think has been missing, like let's say 3-4 years ago, was that institutions saw that there was enough of a market to generate tokenized things themselves. Now with the stablecoin legislation, there's a big boom in stablecoins and tokenized deposits. And that creates a market that can buy your tokenized asset, basically. So if the market of stablecoin purchasing power was 100 billion before, it's hundreds of billions now. And it's going to be trillions. That's a big market. And the second thing that happened to encourage tokenized assets to go on chain from institutions is even though the stablecoin kind of bill from the US in the US, the Genius Act, doesn't have anything to do with the tokenization of other assets. It's a very clear signal that legislation like this can be passed very quickly.
Yeah.
And so and now there's a lot of work on market structure, which is the second big bill, and is the bill that actually relates to the tokenization of assets.
The Clarity Act.
Well, Clarity is the name of it from the House. What it's going to be called in general, I don't know. They'll still figure that out. But at the end of the day, I think once you have assets on chain and people see the power of blockchain technology to create these 24/7, 365 markets, collateral management capabilities, once you compare that with the way things work in the traditional world, I really haven't met anybody that understands that comparison and says, no, you know what? I think I'd like the traditional way. The problem is really people don't understand. They don't understand the difference. And there's been a historic kind of negativity about blockchains and cryptocurrencies that has skewed the mindset of the traditional finance industry towards, all this blockchain stuff is about illicit finance. It's about money laundering. It's about drug dealers. It's about all this random crazy shit. And, now with the government, the U.S. government saying, no, we're gonna support this thing. We want this thing. It's very clear to everybody that A, this is going to happen. B, this thing is safe and actually positive. So that's what I think is going to happen next. Is the market demand is then going to create initial adoption of tokenized assets, and all the related systems that need to power it, like the oracles, Chainlink Runtime Environment, bridges, data, all the stuff. But then once those initial markets are created, the people in the traditional financial system will look at how those markets and how those assets work. And they'll be like, my God, this is 10 times better. So I do think the efficiency will eventually be a big attracting force. But I don't think they'll believe it until the assets exist to create the markets. Does that make sense?
Yeah. But in that point, if the assets exist, I think Web3 has been trying to tokenize everything. from the inside out. So we had like, prediction markets, for instance, is a new market. We try to make a prediction market out of everything, but then there's not enough liquidity. And that brings up like the question of, do we have enough liquidity to make markets out of everything? Well, for sure, a few years ago we didn't. And now by the fact that we are having real world assets like tokenized market funds or bonds or equities that are going on chain, is that shift taking place of there is a market that will drive the liquidity instead of the other way around that we used to know?
I think the liquidity from the Web3 and the crypto side of the equation is something that has definitely helped institutions decide to do some early tokenization. But when you say that the Web3 folks have been trying to do real-world asset tokenization for a while,
Yeah,
I think the problem there is that that's not really their expertise.
mm-hmm.
Their expertise is in creating DeFi systems and markets. To clarify what I mean, if you look at the most successful real-world asset other than stablecoins, it's BlackRock's BUIDL. Why is that? Well, BlackRock is really good at real-world, financial things. And so they made this kind of on-chain treasury.
Mm-hmm.
And then it became very popular in a way that, previous attempts to tokenize funds and treasuries weren't popular. So I think you're going to see a good amount of that. I think you're going to see a good amount of traditional financial institutions that finally get it together and start doing more tokenization of the stuff that they already deal with. So instead of the Web3 person figuring out how to build a bank, the bank is going to figure out how to put stuff on chain.
Yeah.
Right? Which of those two is going to be easier? Well, it depends on who the Web3 person is. It depends on the bank. But I think a lot of the high quality stuff will come from institutions, just because that's their business.
Mm-hmm.
And putting it on chain is getting cheaper and easier. And we're enabling that with CRE and a lot of other technologies. In terms of the liquidity, I think there's really two worlds of liquidity. One world is the crypto, public chain, degen, DAO treasury world of liquidity, right? So it's the liquidity in the public chains, in whatever form, retail, hedge funds, DAO treasuries, whatever. And DAO treasuries were a very big purchaser of the BlackRock BUIDL fund, I think the largest category by far. So, that market has now grown large enough that it in itself as a market is attractive enough, which is great,
Mm-hmm.
which we should all be very happy about. And it's a consequence of all this excitement and speculative activity making those DAO treasuries big, which I'm fine with. That's great. People have capital to do innovative things. Some of them will work, some of them won't work. Welcome to capitalism. So it's totally fine. The other category of liquidity is the institutional liquidity, which so far has only touched our industry through ETFs. That is actually the liquidity that I am very interested in. So I believe that the liquidity of the retail crypto user, DeFi degen, prop trading hedge fund that wants exposure to crypto, that wants to get 8% on the US dollar and, in Aave instead of 4% via some treasury holdings. I think that's a big group. And, I can see that group growing from 3 or 4 trillion to 7, 8, maybe 9, 10 trillion. I can see it. Absolutely. But the liquidity we're talking about in the institutional world is all the money in the world. We're talking about the pension funds. We're talking about sovereign wealth funds from the Middle East. We're talking about really conservative, very wealthy people, family offices. We're talking about all the money in the world. We're talking about hundreds of trillions of dollars. So the real question here is, in my opinion, how do you unlock the hundreds of trillions of dollars in the traditional system to flow into our industry? You should absolutely continue to grow, from 3 to 4 to 5 to 7 to 8 to 9 to 10 in in the organic growth of our industry. That's good. That should happen. And making DeFi reliable, the way Chainlink does with data and bridges and all this stuff, is an important part of that. Enabling DeFi to grow, enabling more exciting use cases to happen in public chains, something we've always all been excited about when we work on Chainlink and with all our users. But at the end of the day, the numbers just, in my opinion, are not going to add up. I think with the organic growth, you get to a certain point, and if you want to go beyond that point, you need the institutional capital. And the only way you're going to get the institutional capital is if you make the DeFi world and the crypto world and the tokenization world what they want. You have to make it work in the way that they are allowed to deal with it. You have to enable them to take custody of things the way they need to. You have to enable their existing trading systems and messaging systems to interact with all these tokenized assets. I think that accelerating their ability to use all this and go on chain is really kind of the core idea of a lot of our work with these institutions. Even, for example, our work with JP Morgan, we connected their private payments chain that has JP Morgan clients on it, which is, JP Morgan, I think, in total has 4 trillion assets under management. So it's not bad.
They're building a tower here.
They've built it, yeah. They have a big tower, that's right. And then we connected that to a public chain called Ondo. So Ondo's public chain. So now the clients of this private chain from the institutional world can use a public chain's tokenized fund, money market fund from Ondo. So it's this type of stuff that I think is a sign of the future.
In what way is we are at the end of 2025? The Genius Act and everything with Trump has been active for a year now. In terms of how big of a magnitude of an impact that has been for the markets, how big has it been?
I think it depends what you mean by the market. I think for the crypto market in general, I would say maybe it doubled the value of the crypto market relative to where it would be if the Democrats got elected. I think it doubled to maybe more triple or quadrupled the value of the market, because you got to remember the alternative is not nobody. The alternative is Democrats and Gary Gensler continuing to, hammer our industry on the basis of God knows what made up problems, right? So I think from a public chain crypto market point of view, it's multiples of a difference in market value. And then I think that from an institutional adoption point of view, it's more than multiples, because the institutional adoption is so heavily tied to regulators and regulatory clarity, not even clarity, but even the signaling from regulators without clarity that this is okay. Which the new SEC chairman, Paul Atkins, who I'm going to see tomorrow at some events and talk to again after meeting with him in DC, is something that he's done immediately. Like, as soon as this guy got into office, he put out speeches talking about Project Crypto and how his goal is to turn America into like the place where tokenization would happen by institutions. I mean, something like that from an SEC chairman a year ago was unimaginable.
It's a complete 180.
Yeah, it's a complete 180. And you got to understand, for institutions, that relationship with their regulator is a non-negotiable. So if the regulator is sending signals to them of like, nah, this crypto shit is not for us, sorry, like, no, Bitcoin's not for us, no, tokenization's not for us, no, we're suing a lot of crypto companies, we're doing, regulation through enforcement, that's how it is. That right there, for most top-tier institutions, stops the whole show.
Yeah.
Like, it almost doesn't matter what else is happening. That already stops the show for most of them. So I would say there it's not even a multiples increase. There, I would say it's like a binary go, no go type of value.
What can stop institutions from moving on chain? Like we just had the big exploit taking place at Balancer. DeFi protocols
they don't know about that.
They're just completely unaware?
I think so, yeah.
But in general, I mean, DeFi is a protocol, it's technology, trial and error. It will happen some more times until it's probably just fixed, or it should be already be fixed. But that's not going to stop institutions from getting into the markets when there's like 100 million being gone from a project like Balancer.
I mean, look, it'll give them some pause. I think now the floodgates are open, and generally speaking, all of these places have extremely rigorous evaluation and onboarding processes. I know because we're in the process of going through some of those onboarding steps with a number of top-tier institutions. Chainlink is ISO and SOC compliant, which is a form of security compliance that's kind of required by many of them. Once we got that compliance, we were already in onboarding, but that even accelerated it more. I think what they're going to do is they're just going to make very selective decisions about, I'm going to use Aave because Aave has a good track record. True. Aave's contracts are audited. Aave uses Chainlink. Chainlink has a good track record of securely and reliably operating the infrastructure that powers Aave. I've done my evaluation. Yes, I can put up to this many billions of dollars or tens of billions of dollars of client funds into Aave. And then, if you have like a multi-billion-dollar failure,
that's gonna
that'll make news. But in my experience, if you don't see it in the Financial Times, if you don't see it in the Wall Street Journal, if you don't see it in the news and information channels that they're used to looking at, they're probably unaware of it. And they're going to rely on their evaluation process to do the risk management, which is that's just how it works.
Yeah. In other terms, we had the AWS outage, I think like 2 weeks ago.
Yeah, a few weeks ago.
That's going to push forward the adoption towards on-chain, probably, if, in your case, Chainlink kind of providing the solution in that sense. In what way is that going to impact institutions when a big firm like AWS has such an outage?
They don't understand decentralization. Like this is not a concept that they fully understand in most cases, for vast majority of people. They understand, hey, there's a counterparty that wants to transact with me against some asset type.
Yeah.
Now the asset type is blockchain stuff. Tokenized funds, tokenized equity, stable coins, all this stuff, right? That's the first thing they understand. The second thing they understand is how costly is this to do? How complicated is it for me to do this transaction?
Yeah.
And that's the thing that Chainlink is massively reducing, right? It's massively reducing the cost of doing that transaction with that institution, with that counterparty. Then they begin the evaluation process and they think about what are the risks. That's where they might run into some of these decentralization ideas. You see how that's a third step, right? That's an afterthought. They run into the benefits of decentralization. They run into AWS outages. And there, just to be clear, that does have value. So at that point in the process, they will look at different systems and they will ask themselves, okay, what is your uptime? How do you resist this failure mode, that failure mode? And when they look at Chainlink, what they'll find is that Chainlink was up for its services, for data services, for bridging services. And when they look at other forms of bridging, other forms of data oracles, they'll find that pretty much all of them were down.
Yeah.
They were down for multiple hours. And these were supposed to be bridges that are so decentralized, and they're great, and their security and reliability is great. And at the end of the day, my experience is that Chainlink is valuable and useful to people because it's a system that has this track record of guaranteeing certain levels of reliability, being able to prove data with certain levels of accuracy. And that's really not something I know of other systems like Chainlink. I know how those systems work. I know how they manage their keys. I can tell. I know what decentralization means. And it doesn't mean the same thing to them that it means to us. And it's very clear. And it shows in days like, that day. The real key to building these systems, actually, that I don't know that many people fully understand in our industry is you're not building the system for the 363 days when everything is smooth. You're building the system for the 2 days when everything goes crazy. When AWS goes down and when, FTX locks up and affects all the market prices. So in the FTX example, that also left Chainlink prices unaffected. That's why Chainlink is Chainlink. So at the end of the day, I think they will evaluate as institutions the track record, the security, the reliability, the ability to deliver price correctly, the ability to bridge and stay up during various of these events. And that will be valuable to them. But it won't be the driving force, right? The driving force is a very commercial calculus of, what is this transaction? What's the cost? And I think that if Chainlink can lower the cost through the CRE, through CCIP, through reliable data, through all these things, then you'll have more institutional transactions.
I mean, we've had a series of events taking place in the past few weeks. I mean, Black Friday, I've heard the phrase for the first time here, has seen an impact in the markets, the exploit, but also liquidity in general due to the government shutdown is quite critical. But you mentioned that in order to get institutions, we need to improve everything. We need to make it easier for them. Quite often it's been about building infrastructure, which is kind of the back end. But then the front end is also important, more of like the UX. And I think during your keynote, you mentioned CRE and you went over it with all the several components of why this is important. It's live.
Yeah.
For people that are listening, what is CRE and why is it so important for institutions to have all those things?
Sure. So the Chainlink Runtime Environment is a place where you can run code to build advanced next-generation smart contracts that work across many chains and that can consume data, consume identity, interface with existing systems, basically all the things institutions need. We've built, I don't even know how many of these POCs, pilots. We've gone into production now with UBS, Fidelity International, many others, after all these POCs and pilots. And what we found over the many years of us doing that is that there's 10, 20, 30 individual pieces of code that start being responsible for making a single smart contract work. Because you have multiple chains, you have multiple data sources, you have identity systems, you have accounting systems, you have reporting to regulators, you have all this different stuff that needs to happen for this contract to work. And while Chainlink has been providing the oracles, so the systems that connect the data to the contract and bridge the contract to other contracts on other chains, and provide identity information into the contract for compliance purposes, and provide access to AI systems for the contract. And we have all of those components. But what we didn't have, and what the industry didn't have until CRE, was a single place to manage all of those components. You see? This is something that you've seen in other big booms and shifts in the landscape of technology that then led to a lot of innovation and growth in adoption and use cases. You had something called Cobalt, which was in the 70s and 80s, a technology that was used and is still used by banks. Then you had the Java Runtime Environment, and the Java Runtime Environment was really what like Web 1.0 applications were built on. More recently, you had something called Terraform, which is something to orchestrate clouds, multiple clouds, into a simple way for applications to use multiple clouds. And what the CRE does is it provides what Terraform and the Java Runtime Environment and Cobalt did, but it provides it for blockchains. So as an engineer at a bank, you can now build a really advanced smart contract that operates around many different operates on many different chains at the same time, can launch on many different chains on the same time. That smart contract can consume data, identity, AI systems, It can report back information to accounting and other systems in the institution. And you don't really need to learn or understand all the details of every blockchain. So that's really, I think, the big unlock is that if that would have taken 20 pieces of code and 5 engineers to do before, and that would have taken them 3 to 6 months, now it takes 1 to 2 weeks with 1 or 2 engineers. And that's at the early stages of CRE's development. We want to get it down to a few hours for 1 engineer for that same work. And the implementations we've already done for institutional users, like JP Morgan, Swift, and others, using CRE, have shown us that it massively accelerates how quickly you can build these institutional advanced smart contracts.
If, just in simple terms, it's basically just connecting TradFi with DeFi and let them speak to each other?
Not exactly. That's kind of what a lot of different Chainlink components do. In simple terms, what the EVM did for smart contracts on a single chain, the CRE will be able to do for smart contracts that have to work across many chains and with other systems. So if you want to write a smart contract that has to work on many chains and relies on many other systems outside of a chain, you can't do that in the EVM now, right? You can write some contracts, but then you need Chainlink, you need a whole bunch of oracles, you need a whole bunch of other pieces of code in other places. So you can't do it in the EVM. You can't do it in any environment on any one chain. You need a system above all the chains that defines the relationship of this smart contract with all chains. So that's the complexity that this resolves.
How do you see like the entire Web3 scope? Like there are hundreds layer 1s, layer 2s. At this point, a stable coin is being created on a daily basis, whatever preferences they have. First question on that is, how do you see those developments? And the second is, if you have CRE, how can you be continuing to hold a certain compliance standard when there are so many chains out there?
Well, that's the hard work that the Chainlink community does, integrating CRE and CCIP and Chainlink data feeds into all these chains. So the whole point is that if you're a data provider like S&P, who recently launched with us, they don't need to learn hundreds of chains. They just implement Chainlink, and Chainlink links them to the chain.
Yeah.
You see the Chainlink?
Yeah.
That's not by accident. So you really don't need to understand chains as S&P. Likewise, if you're an institution and you want to build a smart contract, or you want to launch a stable coin, and you want it to work on 15 chains or 50 chains, you don't need to learn about 50 chains. You just need to write one piece of workflow code and run it in CRE, and CRE will do it for you.
That will also have a big role for AI.
Yes. So it's very easy to implement AI model decision making, AI APIs, all kinds of AI things via CRE.
Yeah. If someone is listening and it's all about institutional adoption, for sure, it's the big liquidity that's going to come into the market. But if big institutions are going to use CRE for an end customer or consumer, what's going to change for them in a few years?
No, things will change. The transaction costs will go down. The accessibility to trade will go up. The assets that they can access. So, for example, if you want to have access to a fund of a certain type, like a healthcare fund or a private equity fund, you can do that now. But I think in tokenized form, you will be able to. So I think consumers will get more choice, more access to markets over 24/7, 365 instead of, no, we don't do anything on the weekends. I think they'll get more reliability. I think they'll get lower cost. I think there'll be more competition among institutions because DeFi and fintechs will come in to compete with them because this technology fundamentally makes it easier and cheaper to basically do what financial institutions do. So consumers will benefit massively in many ways.
Yeah.
I also think they'll experience less systemic financial risk and systemic financial failures because blockchains force transparency and force systems not to fail. So I think there's a huge amount of benefits to consumers, but from the point of view of the consumer's user experience, I think that user experience will be still very similar. So they'll go on their mobile phone or they'll go on their desktop login into Fidelity or Goldman or Bank of America or BlackRock or wherever they have their assets, wherever they're managing their assets. Investment advisors will still exist, wealth managers will still exist, family offices will still exist, all this stuff will still exist, and those interfaces and those kind of mobile apps will simply start offering tokenized things. So that's what will change from UI.
We are now at 2025. We've had the first DeFi summer in 2020. It's been 5 years since. If we look ahead from that point into 2030, where are we if we go into the 0 to 1 global adoption?
Of DeFi?
Yeah.
Where are we on 0 to 1?
We have a new, elections have been.
I think we're about 30% of the way there.
Okay.
I think we'll get to 50% after some clear regulation and legislation around DeFi and why it's reliable. I think we'll get to maybe something like 70% when you have clear and efficient pathways for institutional users to put their capital and their clients' money into DeFi. And then I think we'll be at 100% when you have these kind of pie charts to show the percentage of client money or institutional capital that is in a DeFi system versus a TradFi system. So you are going to start seeing, I think there are going to be charts like this in 2030 where it's like, just like you have for what percentage of the treasury market do stable coins currently hold. Now, it's still not a huge percentage, but as that percentage gets bigger, I think people then start saying, oh, okay, wow, this percentage of all institutional capital is now in this blockchain-based form. Then you go from like the early adopters to mainstream.
And if we look at governments, I think the last time we were saying, or you were saying that governments are getting interested into blockchain. We need to get governments adopting blockchain. At this point, with the acts, we're getting there. What's going to be the status in like 5 years from now where the US is going to be more adoptive of blockchain? Will that spread out through the rest of the world?
Yes.
And then we're just all going to be on chain at that point in time?
Yes. So a lot of governments follow what the US does because they want to be compatible with the US financial system.
It's the biggest market.
And and the other reason is what you said, which is they're the biggest market, right? So you have a big market that everyone in the world wants to access because of the purchasing power of the U.S. investor, U.S. consumer, U.S. financial institutions, which hold client money from all over the world. So yes, I think the U.S. being an advocate for our industry is the best thing our industry could have hoped for.
There's one thing that you are quite often discussing with Stani on stage. I've been to many of the firesides that you guys have been doing. The macroeconomic backdrop. I mean, the year has been tough in that sense. The rates are going down. And in order to get more adoption, you need to have growth in terms of the markets just expanding. What do you think is going to be the impact of a change in macroeconomic behavior coming from the Fed in the coming year in driving the entire adoption forward?
Well, I would say that's the key factor for our industry's overall growth, both in a public chain sense and in a institutional sense. But it's very clear to me, I think, that the Trump administration wants to lower rates.
Yeah.
And I think there's also ideas around printing more money. And I think it's extremely likely that there will be new Fed chair, and that Fed chair will be very much cherry picked to lower the rates and even possibly create more printed money, right? More quantitative, maybe quantitative easing, any number of things.
Mm-hmm.
Because, I don't think the Trump administration wants markets to stall or go down. And, they're pretty economically minded people from what I've seen. Like there is not a lot of, there's some ideological stuff there, but a lot of it is, it's the Republicans, right? It's economics. The Republicans are particularly interested in economics, say above, most things. So, I mean, if nothing goes wrong, if the AI bubble doesn't pop, and if a bunch of other crazy macro shit doesn't happen, which is supposed to happen like 5 years ago, but it doesn't happen for some reason,
Mm-hmm.
If that doesn't happen and you get a new Fed chair, I think, there could be real growth. What that growth results in from like irrational exuberance and an irrational kind of markets point of view is a whole other problem. It's a very big problem. But I don't think we're going into a world where we're going to get a Fed chairman who's going to try to slow markets down.
Mm-hmm.
So I think as long as we get to that guy who's going to do that, I think markets will continue to grow.
Is there, like, just purely hypothetical, but if crypto becomes bigger and DeFi becomes bigger and everything goes on-chain, the fact that the way the banks are structured at this point, it's quite fragile. So if we extract the liquidity from the TradFi world and we put it on-chain, isn't that a risk for the existence of our current financial system? That if we take too much money, that crypto is going to take it down?
No, they'll just make money from doing that. They'll just find a way to make money from that. See, the important thing is that they have the user, they have the client.
Yeah.
Robinhood has their users. JP Morgan has their users. Coinbase has their users. I think people confuse the ability to make a smart contract that does financial things with the ability to get and hold on to millions of users that control billions of dollars. Do I think that Fidelity and JP Morgan, all these folks, are going to just lose their users? I don't know if I believe that. I think what'll happen is they'll find a way to make their users happy, and they'll find a way to make money from making them happy by being the pathway to DeFi. That's how they've survived all these years. Like every time something new comes, like the internet comes along, they don't say, "Oh, the internet, we don't believe in that. We like to do it this way." Oh, the consumer likes the internet? Screw them. We're not going to do what the consumer wants. We're going to do what we want. No, they're all, extremely anxious about what the consumer wants. And, they're very good at adapting to what that consumer wants as long as the regulator allows them to, which in this case they do. And in this case, they're encouraging them to. So, I mean, there's whole thing of like, it'll destroy them. Yeah, it'll destroy some of them.
Mm-hmm.
Just like the internet didn't do any favors to the people that wanted to do banking in the relationship model.
Yeah.
Right. So if you had a bank that was like, I don't believe in the internet, I believe in personal relationships, and that's how my bank is gonna work. You haven't done very well as a result of the internet. You know what I mean?
Yeah.
Because it turns out a lot of people don't really want to come talk to you in your brick and mortar bank. They just want, to send some money, or you see what I'm saying?
Yeah.
But then there were banks that were very adaptable, and they adapted, and they became more successful. So that's what I think will happen.
Is that where your reference comes from? I think you said it yesterday or the day before, that we are in the 1997 of the .com. I think it was
fluctuate on that. I don't remember half the time.
1998,
94, 97, like 95, I'm not.
But it's the point is that it's just before the big escape velocity took place for internet in general.
Yeah, I think so.
And that is driven by the fact that we discussed institutional adoption, that once they are in, there's no other option than to use on-chain DeFi or on-chain.
I think there's going to be a few things. I think there's going to be an improvement in the user experience of dealing with crypto. I think there's going to be this institutional adoption. And just so you know, when I say institutional adoption, I actually do mean fintechs.
Mm-hmm.
I do mean fintechs like SoFi and Robinhood, like new age internet financial companies. I don't just mean big banking institutions. I mean all the systems and applications that currently are used by people to manage their money. That's more or less what I mean.
Yeah.
For me, Robinhood and SoFi and these people are basically like smaller, faster moving institutions. So yeah, I would say that once the user experience gets better, and once it becomes more efficient to use all these tokens, move them across chains, which is what we're working on, and once the existing systems that hold people's money give you reliable access to the blockchain stuff, that's what mainstream is.
Yeah.
I don't think mainstream is everybody takes their portfolio, which is like 40% bonds, 20% equity, 20% something, 20% something, and they'll go, I'm 90% in Bitcoin.
Some people do.
Some people do, but the vast majority of the world, that's not what they do. They say, I'll go from no Bitcoin to 1%, or I'll go from 1% to 5%.
Mm-hmm.
And that's already $1 million of Bitcoin. You see, so the challenge here is not to get them to go to 90%. The challenge is to get all of them to go to 1% or 5%, and then the rest of their portfolio is all on-chain as well.
Mm-hmm.
But it's the on-chain version of it. Does that make sense?
Yeah. So a personal question. It's been quite a challenging time. It's been a busy week.
Mm-hmm.
I've been just talking to your team about your schedule. How do you keep your mental state relaxed and alive during those periods of building a protocol like it is?
I keep it alive. I wouldn't say it's relaxed. I'm not a relaxed person. You can talk to some of the people that I work with and some of them that know me. I don't think relaxed is going to be the word to describe me. And frankly, I like working with anxious people. I find that the people that are relaxed are too relaxed to care about the details.
Mm-hmm.
And so in my experience, being what's called conscientious or detail-oriented is important. And the people that are good at that are not the people who are relaxed. They are the people that are anxious.
Mm-hmm.
So I would say I'm a pretty anxious person, generally, and I work a lot. And I really want to work pretty much only with people like that.
Okay.
And I think that's a good model. And then what you get on the other end of that is you get some amount of success, and you get a lot of personal growth. So my goal in life is kind of not to be relaxed, or really even to be happy. My goal in life is to succeed and to experience personal growth. And so that's just kind of the trade-off I've decided to make.
What type of books or podcasts are you listening or reading that influence you on the way you operate within Chainlink?
Sure. So there's a few categories of kind of canons and schools of thought that have had a lot of influence on me. So Stoicism and ancient Greek philosophy had a lot of influence on me. As I looked more and more into it, you start to see these undertones of Buddhist philosophy and kind of Asian philosophies that have a version of the world where don't worry. Don't worry, about all the things you don't control. The goal of life is not success. The goal of life is not acquisition of, success. I kind of was in that mode for a little bit of time, and I read a lot of this stuff, all Plato's dialogues, Aristotle, Seneca, a whole bunch of guys, Greek guys, Roman guys, whole bunch. And the conclusion I came to is that these folks are really good at helping you deal with the hardships of life. So if you're a stoic person, it means you can go through the hardships of life, in my opinion, well. You can bear those hardships. The thing that actually helped snap me out of that a little bit was Nietzsche. So my really strong recommendation for most people is they should really read Nietzsche. The problem with Nietzsche, just so you know, is he even writes this. He's not a very charitable guy in the sense that he wrote that he's only writing for the people that'll take the effort to understand him. So he kind of is saying, like, if you don't want to suffer through my shit, this isn't for you. Which is a weird way to write things, because most people try to write things to get a bigger audience.
Mm-hmm.
But he says in multiple places that, like, look, I'm writing this, you know, for the people that can understand, and I'm not trying to make it simpler. You know, in fact, I'm making it more complex, so that if you don't understand, you don't get the benefit of it. I mean, that's not the main idea of Nietzsche. I'm not going to go into all the main ideas of Nietzsche, but the point is that you know, personal growth is really the thing that I think people, in my opinion, can realistically aspire to. This constant searching for happiness and this constant sense of entitlement that people are owed happiness by other people or a government or really anybody is really at the root of their problems. Because what happens is they have an expectation that they should be a certain way or that they're owed something. And both of those expectations are completely wrong.
Mm-hmm.
You're not owed anything, and the only thing you have to look forward to is a mountain of problems that you can hopefully get better at dealing with. That's what you have to look forward to in life. There's not going to be that much else to look forward to, realistically. And so once you have this mindset, it's like, okay, I'm on track to deal with a lot of shit, and I should really get a lot better at it. And waiting for a bunch of other people to make me happy is just like this stupid idea that's just going to cause me pain.
Mm-hmm.
And, you know, that's not exactly Nietzsche's ideas, but, you know, that's a version of the conclusion that I came to from his ideas. So I really recommend people, you know, learn the Greeks. The Romans are not bad also. They summarize it relatively well. And, you know, you can read some other stuff. You can read John Stuart Mill. You know, you should learn some economics. If you don't know any economics or you don't know any game theory, it's going to be hard for you to understand what's going on. And then, you know, read some Nietzsche. And, you know, don't listen to stupid people who are not on a trajectory to do something worthwhile.
I mean, I think those are really good tips. So thank you for that. Also, thank you for inviting us over to New York.
My pleasure.
SmartCon was great. First time being in the States, talking on stage. Great event. Really enjoyed it. And I've heard it's going to be again in New York next year, or there are some rumors.
We're still thinking about that. But,
Yeah.
you know, this really was a great event.
It was, yeah.
We had huge institutions. You know, they brought not only the speaker, but the speakers brought many team members.
Mm-hmm.
So we didn't just have, you know, the speakers. The speakers were really senior, but we had engineering leads, product leads. We had multiple engineers. We had entire teams that came to the event.
Yeah, actually, everyone that I bumped into was just quality to talk to. Hats off for that. I would love to talk to you more, but I'm sure we're going to do that in the future.
Yes.
Thank you very much for your time, and good luck on the journey with Chainlink going into 2026 and the coming years.
It's my pleasure.